Today I'm gonna discuss a very popular stock that many of you are actually familiar with. Many of you have been watching it because it's been very volatile. It went down a lot, and normally as investors, whenever we see something going down, we tend to just want to be contrarians and just go and buy the dip, even though maybe the stock is not more undervalued, maybe it's just less expensive, and maybe it's just some kind of a value trap. And this is what I'm gonna try to assess with Estee Lauder today in this video. Ticker symbol EL. It's trading at $183 per share. It topped out over $365 per share not long ago, and now it's sitting at $183. So there might be a pretty good opportunity with this company. And this company is very popular. It owns a lot of popular brands you likely heard of, like Tommy Hilfiger and all kind of other brands. I mean, I'm sure you've heard of many of their brands. And the company has a big problem, and it's not the only one that's facing this problem. A lot of other ones, like Capri Holdings and many other companies in this industry have been actually, facing some problems. Although Estee Lauder is on the higher end, mid to higher end, I thought it would hold up better, but it actually didn't. And we can see how their sales declined over 12% from 4.2 billion to 3.7 billion. But the problem is that, yes, their net sales actually did decline, but their cost of sales actually went up. And this is very bad with such companies. I don't like when this happens, when sales go down 12% and cost of sales goes up 17%. Maybe there was some one-time costs and stuff, but like all other companies, they try to blame it on supply chain. They try to blame it on a weaker than expected China reopening, because they have a lot of exposure in China with many of these brands. So they're saying that it was not as expected. And I also heard other companies say the same thing. But nonetheless, it's a very bad performance and maybe some mismanagement with this company, from the cost of sales going up while net sales actually coming down. Their gross margin from 76%, it's 69%. And their operating income is just an absolute disaster. Yes, there was some, impairment charges, last year, 216 million, but the operating income last year was 738 million, and now it's 297 million. This is a massive difference. Operating margin from 17% to 7%. This is very bad, and this is why the stock, it's been a disaster. Massive move. It went down like 20 or 22% after Jim Cramer, I think, recommended this company. You know how it works with inverse Cramer, but it's been a very bad performance with this company. And they also reported that they expect, sales to decrease between 10 to 12%. And all of this is a very bad news, but the company is a high quality company. They have amazing brands. They have some kind of a moat and brand loyalty with many of those brands, especially MAC with makeup and with women and all these kind of things. So we're gonna take a look and see how much are we paying for all those bad news. Because yes, if we have bad news, but we're getting the right price, I don't really mind buying such companies. I would prefer to buy on bad news if the price is right. But from me, looking at a basic forward PE ratio on a historical basis, now Estee Lauder is trading at 40 times forward earnings with a mean of 31 times, and it traded as high as 49 times with as low as 20 times. So now it's at the higher end of the range, with this company, as you can see, sitting around 40 times earnings. The mean was somewhere here, around 30 times earnings, or 31, 32. So it's way beyond the mean, and this is not because the stock went down. This is actually because their earnings got revised much lower, which is very bad. Now, from me looking at this chart over here, I can see that Estee Lauder is still not at the right price, for my personal opinion, at 40 times forward earnings with the mean of 31. There's no reason why it should be trading as high as it is, especially if you compare it with other players in the industry like LVMH. LVMH is sitting at 24 times forward earnings, while Estee Lauder is sitting at 40 times. And I don't see any justification for that. Yes, Estee Lauder always traded at a premium, and I'm not sure why, but I believe this is a massive gap, especially with something like LVMH trading below its mean PE ratio, while something like Estee Lauder is trading way beyond its mean. So I believe this is not good for the company, even though it's a high quality company. They have high return on capital, but I believe this is a scenario where investors actually overpaid for quality. This is a mistake that people make. They look at a company, oh, it's a high quality company, they have moats and all these things, but they end up actually paying an expensive price, and it's still not going to work out if you're paying an expensive price. And I believe this is what happened with Estee Lauder shareholders, and we can actually see the insiders. They actually been selling a lot even before earnings came out. It's been a pretty good red flag. They sold over 2 million worth of shares at 199. Someone else sold 8.7 million worth of shares at 202. So they've been selling a lot in the months of May, and it's been a good, flag to actually see what's been happening. But I just believe that just looking at those metrics, to me, Estee Lauder is nowhere close to being like all in like type of fear where you're just buying fear. I think there's still a lot of greed with Estee Lauder, and it's sitting at a premium. But I'm gonna take a look at my valuation model to try to determine a fair price for Estee Lauder, and while taking into consideration the quality of the company and all these other kind of things. And I used the analyst estimates over here where they expect a decline of 10%. This is what the management is expecting. And then they expect a rebound of 10% and pretty much 9 to 10% growth for the next 4 to 5 years. So this is what I use in my valuation model. I use negative 10%, and then I use just 10% growth from 2024 to 2027, which is on the higher end, but I believe it's fair for this company. Net income margins right now are somewhere around 7.9%. I put them back at 14%. This is actually not right. It's not 6.5%. But the net income margins are around 7 to 8%. I put them back at 14%, which was the historical average. It's still on the higher end, but I'm gonna tell you why I did this in this video. And using 30 times earnings, which as we talked about here in this chart, the mean is around 31 times. So I would be paying 30 times for Estee Lauder. I personally believe this is a very fair multiple for the company. And I used a 3% dividend, which is a 1.5% dividend. And I included a 1.5% buyback every single year because the company does buy back a lot of stock and their shares outstanding go down. So in total, if you're buying Estee Lauder at such prices, you're getting 64% on the upside, or around 11% combined with the dividend and buybacks every single year for the next 5 years. Now, this is actually not a bad return at all. But for me personally, I like to double my money over the next 3 to 5 years. And if I want to buy Estee Lauder with the intentions of doubling my money over the next 3 to 5 years, I would have to buy Estee Lauder at $156 per share. $156 per share would be, somewhere close to pretty much, the March or April 2020, and I'm not sure if we're gonna get there, but this is, for me, the base case scenario. I'm not gonna bet on something like, Estee Lauder trading at 40 times earnings. If it trades at, 40 times earnings, which is realistic, then if you're buying it right now, you're getting a double of 114% or 18% compounded. But for me, seeing all the things that's happening with Estee Lauder, I would not want to overpay. And I would like to take the base case scenario, which is, in my opinion, somewhere around 30 times earnings, their mean PE ratio. This would be 64% on the upside. There's another company that I'm watching in this industry that I really like, and I'm still watching it, and this is Capri. Capri Holding is trading at 5.5 times free cash flow. Big difference, but they also own brands like, Versace, brands like, other kind of things, Jimmy Choo, all the other things you're familiar with. So there's a lot of other alternatives to the industry. LVMH is still cheaper. So for me to buy Estee Lauder, I would have to buy it, somewhere around $156 per share or lower. If it doesn't get there, I'm fine on missing out. But this was my fair value for Estee Lauder, and thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.